What is gapping in spread betting? A gap is a break between prices that occurs when the price of a contract makes a sharp move up or down, with no trading occurring in between. It usually happens when a share or index opens the trading session significantly higher or lower than the previous day's closing price. It's known as a gap because the result is an empty space on a chart. Gaps can be created by a number of factors. These include irregular buying or selling pressure, earning announcements, a change in the outlook of an analyst, or any other type of news release. Gapping can occur both on the up and downside. Note that gapping is different from slippage. Slippage refers to a particular instance when your stop loss doesn't get filled at the exact price you ordered, but slips a little and gets filled at a lower or higher price. Naturally, in fast or thin markets, slippage will occur, and this is the case with any spread betting or broker for that matter. A gap, on the other hand, is when the market jumps 100 or 200 or even more pips overnight. This can result in your stop loss being missed and your trade being closed at a much higher or lower price than intended. In financial spread betting, if a market gaps through a stop level, you will be filled at the next best price after your stop was triggered. This means you will still be stopped out if the market gaps from a level above your stop to a level below, without ever having a trade done at your exact stop price. Note that this won't happen with guaranteed stops. Here, the stop loss order will be honoured by the spread betting provider even if there's gapping. Let's take an extreme example. Let's assume you decide to short 10,000 shares in ABC Pharmaceuticals when their share price is at £1, with an initial margin deposit of £500. The next day, ABC Pharmaceuticals surprisingly discover the cure for cancer and their share price explodes to £1,000 per share. Not only have you lost your £500 stake, but you now owe nearly £1 million. You'd hope that your supplier would close your bet before it got to that stage, but if the market gaps, there's not a lot you can do. The majority of index and forex pairs are traded on a continual basis, so there is less of a risk of gaps between trading sessions. This implies that there is less likelihood of the price gapping against your position. This doesn't mean that gaps aren't possible, but at least you're able to enter or close positions at any time. Some spread betting providers offer a guaranteed stop loss or controlled risk facility. You pay a premium for this service, but if your bet loses, it is guaranteed to be terminated at a pre-arranged loss, irrespective of market conditions.